Topic, guys, let's dive in, is how to be the bank, meaning how you can create passive income for yourself through being a lender. One of the things that I love about Grid is that when people think about real estate investing, I think buying and flipping come to mind and buying and holding, right? And Grid actually covers what Rob Chavez, the founder, calls the entire life cycle of an investor. And lending money and making a profit through lending money is also a way to create income as a real estate investor. So I want to introduce myself. I'm Matt Greene. I'm an agent, as most of you know, with Coldwell Banker. I'm an investor myself, a small investor, but I represent a ton of investors, and I love working with investor clients. They're my favorite sorts of people to work with. I'm thrilled to introduce Todd Miller as the new co-leader of Grid Philly. So Todd, welcome.
Thank you. I am so excited to be partnering with you and helping take what you've built here and just make it better in any way I can.
Yeah, so Todd, tell everybody a little bit about yourself, and yeah, take it away.
Sure. So as Matt said, my name is Todd Miller. I too am an agent with Coldwell Banker. I've been in the business since 2015. But my primary focus is my investment portfolio. I bought my 13th one today, made settlement 2 hours ago. And yeah, I'm a passionate, I'm a big believer in, if I can help you as a landlord or an investor or as an agent become better, then a high tide rises all ships, which is what I love about Grid. So anything I can do to help you guys with your sales business, your investments, your clients' investments, please let me know. I am far from perfect, but always looking to help when and where possible.
Yeah, I'm super excited to be teaming up with Todd, because I think Todd, even though we're both agents, Todd can bring more of a vantage point of an actual investor who owns a lot of doors. I represent a ton of investor clients and have for the past 15 years. And we're really both excited about creating some more hyper local content. For example, we have a local attorney who's doing a session next month on what pitfalls to avoid when buying estate properties. So look to see more of that sort of content. Please tell everybody that you know about these calls, because the more people that join, the more information that we can exchange, and then the more enlightened we will all be. All right. Quick legal disclaimer, especially for today's topic. You know, you're always going to want to consult an attorney when you're making a private loan. There are legal documents involved. Obviously, this session is for your informational purposes only. All right, so I gotta try to minimize my gallery here because I can't see my screen. There we go. Did you know you can lend money to other investors just like the bank? Okay, so there are, I'm sure most of you are familiar with hard money lending. Todd, is there a difference between private and hard money lending, or are they the same thing?
Yeah, sometimes you hear private lending referred to as soft money as opposed to hard money. I think the only difference is, are you dealing with like the Wall Street corporate side, or just a guy who's got or girl who's got a ton of cash who wants to lend? To me, there is no difference.
Okay, so today what we're going to be discussing is how you yourself can lend money to other investors, make a profit off of it. It doesn't even have to be your money. You could literally borrow money and re-lend that money at a higher interest rate and protect yourself by having you know, some legal recourse if there were ever to be a default. Please note that if you are lending money privately, it has to be on a commercial basis. It is illegal to lend money privately to somebody as a residential mortgage. If you do that, you're required to follow regulations such as the Mortgage Licensing Registration Act of 2008, RESPA, Dodd-Frank, and other laws that regulate the mortgage industry. As always, please consult an attorney for proper documentation and process. All right, so let's say that you've successfully completed several rehabs, wholesales, rental projects. You have come to understand the process, and now you're looking for other streams of income. So did you know that you can lend money from your IRA or by doing a home equity line of credit, which I understand, Todd, you've done that, yes?
Yeah, absolutely. So I think in a market like this, it's smart for investors who maybe own a dozen properties, maybe you own one property. You open up a HELOC on that at 3% and lend it to me at 7%. Like it's a great way to make some easy money.
Okay, and tell us a little about your experience in doing that. Who did you lend the money to, and how did you work with an attorney? How did you structure everything? We're going to dive into that with some of these slides, but I'm interested to hear your perspective.
Sure. So when I have 4 HELOCs on 4 of my rental properties, and I typically use the money for my down money with a hard money lender if I'm going to make a purchase. But there was a time where I didn't buy anything for a year. There was a lot of situations going on that I couldn't invest, but I had my money sitting here close to $400,000. And at the time it was 3% interest. I lent it to someone at 8.5%. I took a lien position on the property through a title company. It was pretty easy, actually. You just got to have the right vendors involved. And it was great. The guy had it out for just about 10 months. So I charged him a point up front and then an interest rate and got all the money back and made money by doing nothing, essentially.
All right, so just walk me through the mechanics of this. So you have an investment property. You typically have to have 25% into it, right? If it's a conventional loan?
Yes.
Yes. And then you can take out a HELOC for what? Up to 90%, or is it 80%?
No. So these are with a small bank in Philadelphia. Actually, they're growing pretty quickly now, and I'm happy to share the contact information privately. But they offer up to 4 HELOCs on 4 investment properties. The only bank I knew to do this. This was pre-COVID. I can't speak for it today, but it was great. I mean, it's how I'm able to build the portfolio at the rate in which I do is by having these lines.
But so you have 75. You have a conventional loan for 75%, and then the home equity line in addition to that, up to what percent of the value?
It's 75% LTV or $100,000, whichever one is lower. Or greater, I should say. It's capped at 100, excuse me.
Okay. Todd, I'm still having a little bit of a difficult time hearing you. I don't know why, so just shout.
Sorry.
All right. What do you need to know, guys, to do this? Well, you're going to need to know how to determine an after repair value. You're going to need to determine how to renovate to add value and minimize risk. You're going to need to know how to estimate rehab costs. You're going to need to know how to pull and review a credit report. And you're going to need to know how to structure repayment terms to provide adequate security for the loan. So how does this all work for a real estate investment? Well, it starts with the borrower signing a promissory note, which is obviously their promise to repay you. Then the borrower would sign some sort of commercial loan agreement stating that the loan will be used to acquire an investment property and pledging that property as collateral against repayment of the loan. So essentially, it's the commercial equivalent of a mortgage. The borrower then signs a deed of trust. I'm not familiar with what this is, Taz. Do you know?
I'm sorry, can you say that one more time, please?
A deed of trust?
Yeah, I did something similar, but it was done by the title company.
Okay. Which, according to this, gives the lender the right to foreclose on the property and take it back if it's not paid. Yeah. Todd, when you've done this yourself, how have you gotten into the first lien holder position? I'm guessing, was there another lender involved or no?
No. So it was a $150,000 loan. It was a $25,000 sales price and then a standard renovation. So it was pretty cut and dry. And the gentleman I lent the money to he paid for the property himself. I financed the closing cost and the rehab.
Okay, got it.
Can I interrupt for a second?
Yeah, of course. Please, you guys chime in. Let's discuss and converse, ask as many questions as you like. This is intended not to be just a conversation between Todd and I, but everybody.
Okay. My name is Elaine Miller. I'm with Guardian Transfer and Keystone Title. I just wanted to give you a heads up. A deed of trust is another name for a mortgage. I just wanted to let you know that.
Thank you.
Oh, it is. Thanks, Elaine. And
so in different parts of the country, they call a mortgage a deed of trust.
Elaine, it's nice to speak to you. I want to give a shout out to Keystone Title, who is a proud sponsor of Grid Philly, as well as My City Mortgage. I'm sure Brian Harsh is on this session or not, but thank you guys for supporting us.
Yep, I'm on there.
Of course, of course.
Appreciate it.
Yeah. So next, guys, a real estate attorney will draft documents for the lender, and the borrower usually pays for the cost of preparation. Elaine, I'm curious, I'm sure you probably, do you do closings, or what is your function within Keystone?
All of the above. So yes, I do closings, and I'm actually coming from a closing that ran over, so I'm sorry, I'm in my car. And closings, I've been in the industry 18 years, so I do all sorts of clearing of title, business development, all of those things. So yes, I could probably answer your questions.
Okay, and so have you ever closed a private loan from one individual to another?
Yes, all the time.
Oh, really?
Mm-hmm. Correct. And
Okay.
I've seen private lenders who use their IRA. There's all sorts of different ways, but yes.
Interesting. And then, so in terms of the closing documents, like the loan package, I mean, do most attorneys use some sort of a template? I'm guessing it's probably different for everybody, but what do you normally see?
So as an attorney, they prepare the legal documents such as the note and the mortgage and the deed, but we generally prepare the deed. Title companies do not have the ability to prepare a note. That must be prepared by an attorney or someone else because of guidelines and so on and so forth. So yes, the attorneys usually have a standard format that they follow. Attorneys in different areas have different formats as well. So it's not like they follow the traditional Freddie Mac, Fannie Mae kind of mortgage. But they do have similar and languages, and some of them do have additional, what do I want to say? What's the word I want to say? Assignment of rents, so other additional documentation. So depending on what kind of transaction it is in an investor world, if it's a multi-unit or not, it all depends. But usually an attorney does prepare those documents for you.
Okay, cool. Anybody have any questions about that, Todd?
No, I just wanted to comment, and Elaine might be the best one to follow up on this. I found it when I was the lender, I found it to be like incredibly simple, but just by having the right title company, and that title company referred me to the attorney who did the paperwork. Is that your experience, that if you have a good title company behind you, you can kind of push these through quickly?
Yes, having your partners and your people in place, you have your go-to person for, let's just say that you're doing the rehab yourself. You have your favorite electrician, you have your favorite, you have to work well with your partners. So yes, having someone who's experienced, who has knowledge, and if I don't know, if I can't do it, I know the right people who can do it.
Yeah.
So yes, that's really important.
Awesome.
Awesome. Okay, your safety net. If the loan is not repaid per the terms, it's a similar process as a bank foreclosure. Elaine, have you ever had to deal, well, I guess after, title is passed, then you wouldn't really be involved with that. So forget I even asked that question. That was a stupid question. The risks, like any loan, collection is impacted by the laws of jurisdiction. I'm sorry, this was written by guys that were based in DC, so they're referencing Maryland and DC here. They're saying Maryland and DC are typically more borrower friendly. The borrower can file bankruptcy and use other tactics to delay repayment and or foreclosure, which can obviously add a lot of times to the collection process. Okay, so here are some typical private lending terms. Todd and Elaine, I'd love for you to chime in about what you have not only done, but what you see. So anywhere between an 8 and 12% interest rate, a 1 to 3 point funding fee, 70% loan to ARV maximum, 6 to 12 month repayment term, prepayment of some interest or all of the funding fee, and anything else that you negotiate, such as construction holdback, rehab draws, etc. Is this consistent, you guys, with what you're seeing in private lending? And if not, what are you seeing?
No, this is extremely consistent. Can you hear me okay, Matt?
Yeah, that's better.
Good. Yeah, this is very, very consistent. And I will say to my younger self, I didn't realize how much of this was negotiable. I think newer investors get so hung up, like, how am I going to pay 10% on money? Like, I think the percentage doesn't really matter. I focus more on the points and then there's hidden cost. Some lenders have an $1,800 deed prep fee or whatever they want to, or an application fee, but you're paying 2 points, where the other lender is 3 points, but no fees. And it all kind of comes out in the wash. So I would say to be really mindful of that. The biggest one that I try to negotiate is the loan to ARV, because the less money I bring to the table, the more money I have to do 2, 3, 4 jobs at a time. So
what's the max that you've seen for a private or hard money loan?
I'm sorry, what was that?
What's the max that you've seen for a private or hard money loan?
I've seen 90%, but those are that again was pre-COVID. I closed on one today that was 85%.
And are you paying a higher interest rate?
Nope, paying 2 points and 8.5%.
And you've worked with the lender before?
I have, quite a few times.
Yeah. Okay. So what did you start at with that lender?
10 and 3.
No, I mean, what ARV did you start?
Oh, sorry. It's a 70, 75%. 70 seems, I don't know, that doesn't seem great to me. I think 75%. And normally I should say it's you as the investor bring 25% of the acquisition and they finance 100% of the construction. So if you buy $100,000 house and it's $100,000 rehab, you only need 25 grand plus closing costs, if that makes sense.
Yeah, it does. Elaine, how about you? What do you typically see for either a private individual to individual or a hard money loan?
That is generally what I see, the same thing. Those are very standard, what you said in the beginning, for fees and rates that I see.
Okay. So guys, I mean, I guess the moral of the story is if you are, seeking out a private loan and it's a 15% rate, that would be outside of the norm. If it's a 5% rate, that would also be outside of the norm. It's a 4% fee, that will be outside of the norm. So these are some guidelines, not only if you're actually lending the money yourself, but if you're taking out a loan or if your clients are taking out a loan, these are very good guidelines to abide by.
Hey, Matt, I have a quick question.
Yeah.
It's mostly, so why go with and I know it's an obvious question, but I'm trying to think of other reasons. So why would you go to hard money versus going to a bank, especially with the way the rates are so low now?
May I answer that, Tom?
That was kind of directed to you.
It's the properties I purchased, the one I purchased today, no bank would give me a conventional mortgage on it. It's not habitable.
Gotcha.
So hard money or private money, or me being a bank, is fantastic for that bridge lending, short-term financing. The hard money I borrow is for 6 to 9 months, sometimes even less, depending on the seasoning period I need to wait. But like if I call John Casey or Ryan Harsh, there's no way that these people would lend to me with the condition of these properties.
And Ryan, I see you on here. So I want to ask Ryan, Ryan, why hard money versus a construction loan?
Time.
Can you guys hear me?
Yep.
There's a lot of reasons. We do hard money too, so we will lend on that. But you can't go conventionally. Now, conventional has come back out with some of their, I forget it's called home style loans, where they'll do investing on construction loans for single families. But if anybody's gone through the process, they'll learn quickly why people use hard money instead. So it's time consuming. The paperwork is a nightmare. So it's not easy. Whereas hard money is going to be a lot quicker. I wouldn't classify what we lend as for fix and flip investors as hard money. Hard money is a little bit faster than us, a little bit less documentation. We're kind of in between banks and hard money. We're going to be a little bit more documentation. It takes still 21 to 30 days to close, but not quite as much of paperwork as if you went to a normal bank. So, hard money is your faster, quicker option. And just like everything, time is money, so it's more expensive. So, you can always go to the Meridians of the world and the First Trusts of the world and go through that process. But, you're going to get cheaper money and cheaper points, but it's going to take a lot longer and a lot more paperwork to do it.
When you say, okay, so just to break that down a little bit or unpack, when you say it's going to take a lot longer, are you talking about the application process, approval process? But once it's approved, does it still take longer to like disperse the funds and the construction?
I'm not sure. I've never actually worked with those banks. I know for us, generally when you take a draw, it probably takes 3 to 5 business days to get your money. And that's just because you have to get the inspector out there. So I usually, tell people, if you know that you're going to have your plumbing done on Friday, call us Wednesday, and we'll get somebody out there. But as far as, I can't speak for other banks' draw processes, they're all different. So I don't know if anyone's ever worked with them, how quick they are, but I would imagine the draw process is a little easier than the actual underwriting process. The underwriting process was what I was referring to, where it can take, up to 60, maybe even 90 days, depending on how complicated the scenario is for you.
Yeah, Matt, I just want to piggyback on what Ryan said. It's if you go to a bank like Meridian, it is cheaper for sure, but they might need 6 to 8 weeks to close the deal. The deal I closed this morning, it took 9 days. Now that's really fast. Title was already done, so there's a lot of factors in that. But yeah, Ryan's 100% right. Hard money is quick and dirty, and that's why a lot of people, myself included, love it.
Okay, so Todd, can you walk through this example so this would be, we need to flip back into the role of you yourself being a lender. If you can walk through this example.
Sure. So if a friend calls me and says, "Hey, look, I have a deal. Can you finance it for me?" I would ask for all these bullet points and then elaboration. I always start with the finish line. How much is the property worth? What's the ARV after rehab value? And then the $300,000. Okay, and you're buying it for 175 grand. Now that to me is tight, because if you look at the bottom there with the max loan amount, I don't know how you're possibly going to do any sort of rehab for that amount of money. But it's fine. Let's assume that all this is correct. So
I think this was written about 12 years ago.
Yeah, I was just going to say, but
okay.
No, we can stick with it. So $300,000 goal line, perfect. You're buying it for 175. You need 6 months, which is very reasonable to do construction. When you take in the construction holdbacks, which I'm happy to explain in a minute, and anything else, you the buyer are going to bring 50 grand to the table, meaning your max loan amount 70%, 75%, whatever of the ARV is how you arrive at the 210. You guys know what construction holdbacks are? Do you want me to explain that quickly?
Yes, please.
So a construction holdback is...
I hold that microphone closer. It sounded better.
Is that better?
Yeah.
Okay. A construction holdback is if you're going to ask a lender for a $25,000 draw because you're going to do all the rough-in, let's say, they'll say, great, but we're going to hold back 5% of it until the very end, just as a safety net for the lender. Pretty common especially on your first couple deals. This next slide here is explaining you as the borrower, your cost. So 12% interest is $2,100 a month, and the 2 points up front is $4,200. I want to say too, when you're vetting lenders, private or hard money, make sure you're only paying interest on money that is on the street, not on the full loan amount, because it's cheaper for you up front. Prepaying too much interest is pretty standard. Now I actually do 3 months. The cash to close all averages out to 28 grand. So you're doing a $300,000 goal line and a $200,000 loan for 28 grand out of pocket. That's fantastic. Yeah, it explains it all to you right there at the bottom. I'm not going to read it verbatim, but in this example, I personally would absolutely lend to this.
Okay, so let's go to the next one, because this is what the lender profits, correct?
Yep.
Real quick, when you lend as a hard money lender, is it for the whole rehab and the home and the property, the sale price of the house?
So yeah, that would typically be it, right? If you're buying a house for 100 grand and if you're putting 100 grand into it, the lender would give you $175,000. You would bring 25% of the acquisition just to have some skin in the game.
Gotcha. Okay, cool.
But again, that's all negotiable.
Thanks.
Yeah, of course. So under that scenario that we just reviewed, this will be profitable for both people. I would say more profitable for the buyer in this context, but yeah, as a lender, you would certainly make some money.
Cool. All right. So what should your borrower provide to consider a loan At least a minimum amount of equity, never lend 100% of the required funds. That should be obvious. Proof of funds for required equity, that should also be obvious. Credit application, everybody who's ever bought a house should know these basics here. A fully executed purchase contract, an estimate for renovations from a licensed contractor, proof of insurance for the property. And that is it for the slides. So who has questions, comments, stories?
Has anybody on here ever borrowed hard money or soft money or private money?
Lorraine, I see you on here. You have.
I have not.
Matt, who did you say has?
Yes, I have.
I have. I'm actually in a different market. Everyone here is from Philly, right?
Yeah, I believe most of us are, yeah.
Oh, okay. Yeah, I'm actually from Chicago. And yeah, basically all the general terms that you guys laid out are pretty standard. Kind of for what I look for out here, because this market is completely different. I look in like a lot of the very, very cheap areas. So I'll pay like my private lender 12%. But I'll fully amortize that over a 5-year loan. So it's more of like they're making monthly cash flow because they're getting a monthly principal and interest payment versus like the 8-month recycle.
Yeah, that's awesome, especially for you as the borrower, because when you are paying that monthly payment, it's not nearly as daunting as if you're focused on the whole rehab number, right? Would you agree with that, Derek?
So say that again. When I'm paying the
sure, yeah. So when you're paying your monthly principal and interest, it's not as daunting as if you're paying 12% on the ARV number that would be on the street for those 6 to 9 months of your construction. Is that correct?
Oh yeah, definitely. I'm only paying the principal and interest on the purchase.
Yeah, that's awesome.
Derek, are you an investor? Are you an agent? Are you a lender? Are you all of the above?
I'm solely an investor.
Oh, awesome. Okay, what are you seeing? Just this is way off topic, but I'm just always curious. What are you seeing in the Chicago market, like the city?
Yeah. So like the downtown proper, I know there's a lot of like backed up inventory. A lot of people are kind of like hesitant to move downtown. And then I know the suburbs, I think it cooled off a little bit, but they were extremely hot. Like going just exploded. But the downtown is definitely like still has a lot of inventory.
I have a guy in my mastermind group that lives in Naperville. Do you know where that is? Is that a suburb of Chicago?
Beautiful.
Oh yeah, that's a very nice western suburb. So like the Naperville market is probably like.
I know. I hate hearing about it, Derek. I have to hear about his offers, and and I want to reach through the phone and strangle him. So okay.
Naperville is the main line of Chicago for sure.
Oh really? Okay.
Oh,
well,
yeah.
whatever. Great.
hey, Derek, I got to connect you with Nina, who's on the call. She's doing a burr out in Chicago. Nina, am I correct in that?
Yes, you are.
Do you want to tell Derek quickly some information about it, if you don't mind sharing?
So it's still we still have not settled. It's I am getting a hard money loan, but I haven't actually done anything yet because I'm purchasing a property that from someone who bought an entire portfolio, and there's a lot of title issues. So it's been going on for a couple months now. Actually, we were looking to settle back in August and I still haven't. So
jeez.
Yeah.
What area is it in?
I live in Delaware, so I'm connected with another group. And so I don't know all the areas of Chicago. It's on Harvard Avenue, but I don't even know the areas of Chicago to tell you.
Yeah, maybe like later we can connect, and then like if you ever need help, like me to look at it or connect you with someone over here, I could definitely.
Okay, great. Thank you.
That's awesome. Great job. Andrew asked a question in the chat about any investors who survived 2008 and what happened with home values. Andrew, I personally, I was in college in 2008, but I can tell you, if you are a buy and hold investor, the value of the property, like, I know this sounds weird, doesn't really matter if you're holding it, because if you're collecting your rents, and this all happens during underwriting, but if you're collecting your rents and making your payments, the market can go up, down, left, or right. You're just focused on paying down that debt. Now, if you're flipping property, whole different conversation. But Matt, you were an agent in 2008, I believe, right? What
I
did you
most
say?
certainly was.
Yeah.
So here's my response to you, Andrew. Take notes. You buy more real estate when the real estate market collapses. You buy as much as you possibly can. Hold on to it. If the value falls below, don't worry. It will come back. It always has. If you chart this back to, I think Case Shiller goes back to 1850. There has never been a time where real estate values have gone backward for more than, I don't know, 6 or 7 years. The collapse in 2008 was the longest. So just hold on to it. You'll be fine. If you have to get rid of it, if that's the question, and the value of the property is lower than what you own the property, then that's a problem. You have to short sale or the lender will foreclose.
Yeah, I would say I haven't lived through 2008 crisis. I was like in middle school. I'm 26, but from the people that I've spoken to who have, a lot of them really said just basically getting into too much debt. So I feel like if you're doing a bird deal, only take out, this is just a personal preference, but only take out as much as you put in. Like if your appraisal comes in over than what you put in, I personally wouldn't recommend taking all that out because I just feel like it's good to be at a much safer debt position.
Oh, totally. I totally agree. Derek, I had a listing that was on the market. This is so funny. And it did not sell for, the property had some problems, but it was listed at $639,000. And the owner refinanced the property and it appraised for $870,000. And she's like, I will not be taking that extra money out. And of course the lender's like, how much money do you want to take out? And I said to the client, I'm like, please don't take out more than, whatever, 600,000, because obviously the market did not support that price. So I totally agree with you.
I think a really great lesson for investors, new or seasoned, is to understand the difference between a sales price and an appraised value on a refi. They are very, very different things. And I myself feel over leveraged at times when I look like, wow, I got a $300,000 ARV, but it can only sell for 250. But again, if you hold them long enough, those lines cross pretty quickly.
All right, guys. Anybody else?
Hey, yeah, this is Chris. Question for Todd. As a individual private money lender, different from like a hard money fund or someone larger, like how do you go about finding people that are looking for, private money, and what is like the typical kind of ticket size you're lending?
Yeah, that's a great question, Chris. I appreciate you asking. It's hard. Like I'll put it out there once in a while when people ask me if I lend money, and whether I personally lend it or some of my friends who love real estate but don't have the fortitude to be a landlord will do it. But I would say those opportunities more come to me. I know it sounds so conceited, I'm sorry, but they more just come to me rather than me seeking them out.
Yeah.
Well, let me jump in here. This forum is a fantastic opportunity to find that, Chris. So if you post on the Grid Investor website, which is not only Grid Philadelphia, but all the Grid chapters, including Grid headquarters in DC, I can almost promise you'll get many, many, many responses of people who would lend you money privately, if that's what you're asking.
Yeah, and actually, Matt, just to quickly piggyback on that for Chris, in today's market with all the insecurities with the inflation and the stock market, I know people pulling their money out and looking to do private lending solely for that because they believe so heavily in real estate. So if you yourself have an opportunity or you want to lend privately, send me a message. We can talk more about that. Or you use the Grid Network, which is an amazing resource.
Or Chris, I'll be sending everybody a follow-up email along with Elaine's contact information. Connect with her. She obviously has resources both with Keystone Title and also with attorneys that she works with. Awesome. All right, guys. So our next call is on November 18th. Our guest speaker is local attorney Mike Diallo. He's going to be walking everybody through some of the pitfalls to avoid when you're buying estate properties. I'm personally super excited about this because as many of the estate properties as I have helped people purchase, I don't totally understand the probate process, so I've got a lot of questions. I want to thank Todd. I want to thank Ryan Harsh and Elaine Miller for supporting our group. I'll be sending everybody a follow-up with a link to this recording. And Go out and make some money, everybody. Have a great day today.
Bye, guys.
Thanks.
Thanks, Matt. See you guys.